Valens Research, Uniform Financial Analytics.
Universal Display makes the technology that backs basically the semiconductor chips that back basically LCD screens, all the other different technology that is display technologies on your phone, on your TV, on your laptop monitor. They basically make the IP and technology and sometimes the chips that stand behind that. And so whenever we look at Universal Display or any company under uniform accounting, we always start with this page. This page, the PVP page, which is short for Performance and Valuation Prime page, is the landing page every company starts at. And the reason why we start here is in the name, right? We focus on the PVP, the Performance and Valuation Prime, because you'll get a trend here, right? The Valens, we're very literal in our names because of the fact that we focus on the idea of what is the company's real performance and what is the market's real valuation for this company. And so the first two charts here that we can see are ROA, return on assets, and asset growth, right? And so those two metrics are the two metrics that help us understand what is a company's performance, how profitable is it, and how much is it reinvesting in the business. And you can see, just looking at the historic years, right, all the years from 2019 in history, you can see we have two bars here. We have an orange bar and we have a blue bar. The orange bar is the as reported GAAP or IFRS distorted returns to the business. Well, the blue bar is the uniform accounting true blue, once we've adjusted it, real returns of this business. And so when we look at a company like OLED, right, like Universal Display, what immediately jumps out to us is how wrong as reported metrics are in terms of how profitable this business is, right? OLED, Universal Display, is a business that is really actually a patent licensing business at the end of the day. That's a core part of what they do is their IP. So if you're looking at a business that is a patent licensing business, which is generally more asset light than most semiconductors are, semiconductor companies that have a lot more invested capital, you'd expect high returns. And the fact that you look at this company and see only 10% returns when you look at it on an as reported basis would tell you maybe their actual IP is not that valuable. But in reality, when we look at it and we see the true uniform accounting numbers, once we remove all the accounting noise for this company, what we can see is actually this company has very valuable IP, which is why they've basically been above 20% almost every single year for the past 7+ years since their technology and since their innovation became relevant. But that's not all that we're looking at, because to understand performance, we don't just need to understand what returns are, we also need to understand asset growth. Right, and here you can see the exact same thing. We have the distorted as reported asset growth for a company and the true blue uniform accounting asset growth. And what we can see here for Universal Display is a company that has been consistently reinvesting in its business over the last 9 or so years. That's good, because when you have a high return business, you want that high return company reinvesting in itself to be able to create more value for shareholders. On the other hand, if you were looking at Universal Display on an as reported basis, you'd see a company that generally did not generate returns much above 6 or 7%, and yet was still plowing money into the business. You think they were destroying value when you thought about them deploying assets into the business. That's incredibly important because it changes how you think about the questions you're going to ask management, the areas you're going to focus for research on a company, et cetera. It's really about understanding performance. Right? What kind of strategy is management implementing, and does it make sense based on what they're doing, based on what the returns the business is generating? But the really powerful thing also about these two charts is these two charts are fundamentally an easier way for you to understand the question of free cash flow, right? So many people focus on this idea of free cash flow for a business and what is it that the returns are for a business in terms of how can you focus on where is this company throwing off cash flow or where is the company not throwing off cash flow? And when we look at from a free cash flow perspective, what we can actually see here for the company is this company is generating, right, on every $100 of assets that they have, they've generated $36 and they're reinvesting $15. So, but however, what we are seeing with the cash flow stream is not just this, the idea of returns and asset growth, but also we can understand not just that, but we can understand actually the future DCF. And this is what's really powerful when we talk about performance. By the way, apologies everybody again that I lost Wi-Fi there for a moment. What we're seeing here is these light blue bars and these white bars are understanding what our first analyst Wall Street estimates for this company's returns for the next few years, and then the white bars, what is the market pricing in? Because it's not just enough to say how is a company done historically. If we want to understand whether or not a company is overvalued or undervalued, or as importantly, if we want to understand if we as investors have a different thesis from the market about what a company is going to do, well, the first thing we need to understand is understand what the market thinks. And so what we do here is we don't just give you history for a company, we also give you an understanding of what our analysts forecasting their returns to be once we make the uniform accounting adjustments, and whether or not the market has higher or lower expectations for both asset growth and for ROA. We'll come back to what our conclusions are about that for this company once we finish the other three panels here. So the third panel that we have here is value to asset prime ratio, or our adjusted price to book, our adjusted price to book assets. We compare that blue bar to the orange bar, which is the as reported price to book equity for a company. And what we can look at when we see this for a company is a very strong relationship between the multiple a company trades at relative to its asset base and the returns a company is throwing off. Higher return companies generally trade at a higher multiple relative to their assets. Low return companies generally trade at a lower multiple relative to their asset base. But then what we can also look at is a classic PE analysis. So we have PE, traditional PE, and then we have our uniform accounting PE, which we call VE prime. And so we can see here is very similar to traditional VE analysis. We're trying to understand how much is the company how much is the market paying for a company's earnings? And right here, what's really interesting that we can see jump out is this company is actually not trading at as high of a multiple as reported metrics make you think. In reality, this company is trading at a 40 times multiple, still expensive, but not 50 times. And that actually makes a difference in terms of how high expectations you think they are. But then the last chart we have here is TSRR. Right, so TSR, for those of you who don't know, is total shareholder return. Total shareholder return is basically think how much do I generate in terms of return from owning this company's stock? Meaning when I combine the capital gains I'm getting from stock appreciation any given year and the dividend income I'm getting when the company pays a dividend, combining both of those into a total return, total shareholder return. And then that second R there for TSRR is total shareholder return relative to the market. The market meaning the S&P 500 for this company. So what you can look at here is when this line is flat, like it was here, well, that says that the company performed in line with the market. When it's down, like it was here, that says the company underperformed the market. The market was up more or down less than the company. And when it rises, like here, that means the company outperformed the market. Now, what's really interesting is if we look, what you can see is this TSR trend, and this is the point that we're making about uniform accounting metrics, much more strongly tracks what we're seeing for a uniform accounting ROA and asset growth perspective than it does the distorted as reported metrics. Why? Because the major investors out there, think guys like BlackRock, et cetera, they're looking at data like this. And if you're not, you're missing the story. But so with that in mind, let's look back to Universal Display and understand from a valuation perspective, a company that's trading at a 40 times multiple, what does that mean the market's pricing in for Universal Display? And what that means the market's pricing in for Universal Display is the market's pricing in returns, which were 36% last year, to rise as analysts forecast to about 45% in 2021, and then moderate a bit, but still stay near all-time high levels. And on top of that, the market's also pricing them to continue to compound at a 12.5% rate a year. Right? That basically says every single, call it 6 years or so, this company is going to double in size. That's what the market expects this company to do. But let's say that we have a divergent view. Let's say that unlike the market, we think this company can continue to grow at a bit higher rate. Let's actually just say 15, because of the fact that we believe this company actually has a phenomenal growth opportunity in all of its end markets, right? We're continuing to have more screens in our households, et cetera, especially as we have the at-home revolution happening. And so we continue to see investment, but we think they're going to have competition. So we think it's more reasonable for returns to actually fade down to 30% or maybe even 25%. We can quickly do a scenario analysis here and understand what that means. So we can see that means this company would be worth about 15% less than the market currently thinks it's worth. That's actually not an unreasonable number. So let's say that we think this company actually is only going to grow at 10%, and we think that competitive pressures are getting stronger, right? That's when we can see this company might only be worth half of what it currently is now. And that's important because it helps us understand when you had a company with very high expectations, like Universal Display does, if you don't understand what the as reported, what the real numbers are for the business, you don't understand whether or not those expectations are reasonable or not.
Valens Research, the world's leading source for uniform financial analytics.